All right. Matt the Mortgage Guy here. In today's video, I'm going to talk about how I changed my mind about mortgage interest rates. Before I jump into the video, please like, comment, subscribe, do all that stuff. I'm a mortgage broker who just shares my opinion on mortgage rates, the housing market, real estate, all that good stuff. So if you like straightforward information from somebody with boots on the ground who's talking to hundreds of consumers, hundreds of agents, active every single day, please consider subscribing to the channel. So I'll just jump right into it, and I'll tell you that in past videos, I had talked about my prediction that we're gonna see an increase in interest rates. And just everyone's favorite barometer is the 30-year fixed rate mortgage, which currently is below 3%. A lot of forecasts, whether that's the MBA, Fannie, Freddie, these different organizations that have looked at mortgage interest rates. Some of them said it was going to be 3.3%. Some said 3.5. Everybody kind of landed somewhere in that mid threes range by the end of 2021. Here we are in July. The Fed has done next to nothing. They come out of a meeting today. They say pretty much nothing. And I think that I may be changing my thoughts on the future of interest rates, because I think I underestimated the Fed's ability to continue to kick the can down the road, continue to just talk about nothing and do nothing. Does that mean that I don't think that they're ever going to taper their buying of mortgage-backed securities? No. Do I think that like nothing's ever going to change? No, but I just think that I underestimated their ability to kind of push this thing out a little bit farther than I expected, anyone else expected. So what does that mean for you, the consumer? In simple terms, I think this low rate environment can last a lot longer than I initially thought. I was really worried about a tick up in rates that was going to cause not just an affordability issue, but it was going to cause a lot of on the fence refinance clients of mine some pain because they were going to miss out, right? Rates were 2.625 today or 2.75 on their scenario. And I was advising folks that, this may not last. Let's hurry up and get you refinanced. Well, I'm not going to be surprised if rates stay below 3% through 2021. Is it a guarantee? Of course not. But is it more likely in my head than it was just last month or the month before? I think so. And, just for an update on the Fed and their meeting, which they had for the last 2 days, and what they said, I think a lot of us knew nothing was going to change. They weren't going to raise rates and do anything about their purchase of mortgage-backed securities, which will affect interest rates. But we thought that they might give hints or talk about when they're going to start this tapering, meaning buying less mortgage-backed securities in the future. They literally didn't say much of anything on that. Jerome Powell said, I think we're some way away from having had substantial further progress towards the maximum employment goal. So we're not ready to make any changes, right? And then when he was pressed on inflation, they stick to their guns, saying that it's transitory. The only problem with transitory is what I was reading about the Fed's response and what they said about this transitory inflation is they kept getting pressed on what does transitory inflation mean. And they're saying that it means that, sure, we're seeing some inflation, but it's transitory, meaning it's going to stop. And here's my thought from a simple man's brain. If things go up 8%, and then next year, like that tick up in inflation stops or goes back to normal levels, well, something that cost $1 is still 108. And then if it goes up another 2% the following year, if it returns to normal, right? Then it's still 110 or 111. And then another 2% on that is 113, 114, whatever those increments are. But you don't erase that 8% or that 10% or whatever type of inflation we're seeing now. It just means that it returns to normal, that, short-term massive inflation that we're seeing is going to return to normal. And so it doesn't mean it goes away, right? And so that so-called transitory inflation still sticks with the things we're buying. Food, gas, all that other stuff. So I don't know. I don't know what it means for the future, but I just wanted to come on record saying I called for higher rates by the end of 2021 from everything I was seeing. Now, as I listen to what the Fed is doing and I see how the markets are reacting, I think that we might just be in this low rate environment a lot longer. You know, with all the money that's being printed and all the debt that we have as a country, who knows? Maybe we stay in this low rate environment long term because as a country, we can't afford to raise the Fed funds rate. I don't know, but just my thoughts for the day. Let me know what you think, what your predictions are for the end of 2021, for 2022. I like when there's comments, whether I agree with them or not, and people kind of giving their 2 cents, what they feel about it, because I think it's an interesting topic, especially for me who's dealing with clients every day where this affects their ability to purchase. This affects whether refinance makes sense. A lot of people who are currently in the real estate market might be buying a new build, and that's not going to be finished for 6, 9, 12 months. They really want to tune in to what's going on with interest rates. So if you found this helpful, consider subscribing. I appreciate you watching. If you're looking for a mortgage in California, me and my team would love to help. Matt at mattthemortgageguy.com. If you're outside of California, let me connect you with a great mortgage broker who can help you in whatever state you're looking. Greatmortgagebroker.com. Quick form, you fill that out, we'll get you connected. Thanks for watching.